In this video, we're going to look at a very important BlackRock report about how they see the investment landscape in 2023. There is so much very good information in here. We're going to cover the main points and how that relates to Bitcoin and crypto over the next 6 to 12 months. BlackRock see many changes in the works, and so we can relate this to how Bitcoin is going to fare in this environment. As you can see here, over the next 2 to 3 months, there is a lot of data coming out that is going to really affect the price of BTC. But with Bitcoin, we have inflation figures coming over the next few months. As you can see, we have 2 Federal Reserve meetings as well, which will probably see the end to rate hikes. And then we have the jobs reports. The Fed are trying to crush inflation through making more people unemployed. So these 3 jobs reports are very important too. Before we get into the BlackRock report, if you are a trader, deposit bonus on Bit up to $8,000, 0 commission spot trading on there right now as well. So if you are an investor, you can use 0 commission and take that out to your wallet. Link in description for that. As you can see here, BlackRock are really focusing on inflation generally and a potential change of what has happened over the last 40 years. They call it the Great Moderation. A recession is foretold. This is in 2023. Central banks are on course to over-tighten policy as they seek to tame inflation. This keeps us tactically underweight developed market equities. We expect to turn more positive on risk assets at some point in 2023. That's really important. So that's telling us that even though they are right now tactically underway, that means they're not really massively bullish on equities. They think they've got further to fall to price in a recession. They think at some point in 2023, they could actually turn more onto risk on assets because essentially they see a bottoming process. The recession hit, earnings come down in a couple of different quarters, but they see at that point potentially moving back into equities. Considering equities are a long-term investment, taking risk at historically low prices is always good if you have a 5 to 10 year time horizon. So that's what they're saying. I relate that to Bitcoin as well, given that I think Bitcoin generally is kind of a risk asset, it's kind of priced like that. And so what they're saying is within the next 6 to 12 months, they're actually going back, putting some more weight into risk, but not yet. We expect inflation to cool, but stay persistently higher than central bank targets of 2%. Equity valuations don't yet reflect the damage ahead in our view. We will turn positive on equities when we think the damage is priced in, or our view of market risk sentiment changes. Now, when it comes to Bitcoin and crypto, we can't just say that Bitcoin and crypto trade along with equities. They do have a correlation, but equities are a broad-based index, right? You have healthcare, financials, industrials. Bitcoin and crypto is essentially that risk end of the spectrum, more like Tesla, Amazon, Google, right? The kind of growth end. And so they're not going to have a perfect correlation with the stock market in general. What happens usually with risk assets, especially far out on the risk curve, is that they price in recession first and price in the end of the recession first as well. So just to keep that in mind, a recession is bad, obviously, for all of us, for investors, for normal people, for working people, but it doesn't mean the end to growth. And I think that's really important here, especially with Bitcoin and crypto, which objectively just is a growth area and has very good growth year over year specifically. I think it can do well in an environment of lower growth, considering it will have comparably higher growth to the general market. But anyway, as we can see here, a new regime playing out. This is what the central banks are having to do right here. So aging populations led to worker shortages. This means DMs, developed markets, can't produce as much as before without creating inflationary pressure. That's why inflation is so high now, even though activity is below its pre-COVID trend. I don't agree with this, to be honest. I think it was money printing and shutting down all of the supply chains, and China basically been shut down this whole time. I don't see how a slightly older workforce really makes a big deal, to be honest. But either get inflation back to 2% targets by crushing demand down to what the economy can comfortably produce now, or live with more inflation. For now, central banks are all in on the first option, so recession is foretold. We're just going to have a look at this as well in terms of what a recession actually is. As you can see here, Jerome Powell has always been saying over the last 6 months or so, we're just going to prepare for a period of below trend growth. What he means by below trend is this yellow line right here, which was the previous kind of pre-COVID trend, right? So that was the trend of GDP. So obviously the area now is below that, because what they have to do after they printed all that money right here to bring us back up to that trend is now they overdid it. And so they have to pull us right back away from this yellow trend line. And so that recession is essentially that, pulling us back down to a lower trend, because too much demand is causing that inflation. They can't have that. They're going to crush that demand, bring us down. It doesn't mean once we get there that we can't then move to maybe below trend growth, right? So there is still going to be growth, but there has to be a drop in GDP. Now, that is assuming that essentially nothing changes with supply chains, but now we're seeing China start to open up, which is obviously going to make a big difference to supply chains and to supply and demand within the world economy. That, in my opinion, might take 6 months to a year to fully work its way out. We have Chinese New Year at the end of January as well, but after that, we would expect much more opening up and competition forcing prices down within the supply chain as well. So it's not just monetary policy that can change this. The supply chain should be getting better in 2023, probably towards the second half. Also important as well to understand, if you're a long-term investor, it's all about time horizons in terms of how you want to play things. You can see BlackRock here. We are already at our most defensive stance. Other options are about turning more positive, especially on equities. Important if we just say that Bitcoin is more of a risk on asset, it's going to do well when the economy turns back to some sort of growth. BlackRock, world's largest asset manager, is in the most defensive stance right now. And so do you want to be selling assets during this time? Do you want to be going risk off during this time? There's a few ways to play this, right? The first one is to just dollar cost average and take a little bit of risk when most other people are risk off, if you have a longer time horizon than them. If you're a younger person with a 5, 10, 15 year time horizon, then these are typically great times to invest when risk is cheaper. Or if you're slightly more tactical, do you actually want to wait for that recession to come in and potentially turn more bullish on risk when you're, turning the corner of that? Well, as you can see here, BlackRock are essentially right in the top left quadrant, which is risk off in equities, as you can see here, which is risk off on risk, essentially, right? Going a bit longer on credit because of interest rates being higher, but generally negative on long-term government bonds. Again, with slightly higher inflation and lower growth, they may see longer-term bonds actually sell off. But what you can see here is that they're neutral on short-term government bonds. You'll see throughout the report that they're basically saying that rates don't have much higher to go, and the next stage for them on the short end is to come down, which makes sense if there's a recession as well. So they're tactically way risk off right now. If you're a longer term investor, then these are historically the times to take risk, given that your own portfolio can manage that and your own costs in your lifestyle. BlackRock focus on two main time horizons for their report right here, which is short term, 6 to 12 months, and then long term as well, which is a decade plus, which if you've got a decade in you of investing, it's typically better to invest in risk, especially when others are going risk off. That's typically the best thing, but it is difficult as well because of really two reasons, China and Russia, right? So as you can see here, loose policy is not on the way to help support risk assets. I firmly agree with this. Central banks have said, especially the Fed, they are not going to pump the market. Inflation is too high, supply chain can't handle it, and so they cannot pump the market like they've done after 2008, which was cut rates, supply money, QE. They're not going to do that in the same way that they have done previously, because the supply chains cannot handle that now. And so there's no point just pumping the market, not having a supply chain be able to cope with it. Now, China has, been a great help to Western inflation, essentially creating deflation over the last 20 plus years, exporting goods and service production over there. But because they're shut down, that's an issue now. And so the quicker that China can open up, and they are doing that now, if they can do that as quickly as possible without too many issues, then that is definitely going to help things. And that could see a little bit of a turn to risk on, probably mid to late next year, after, whatever happens in the economy in the first half in terms of the recession. As you can see here, it's not just about pricing the damage. We could see markets look through the damage and market risk sentiment improve in a way that would prod us to dial up our risk appetite. But we're not there yet. So BlackRock are trying to time this recession, right? And saying, we think probably the first 2 quarters, going to be very difficult. But as China opens up, that opens up supply chains potentially. That's on a net basis, probably good news and deflationary overall. And that could see a return to risk, but not there yet. What the author of this report is trying to call is the bottom. And no one can ever call the bottom, but that's what they're trying to do. As you can see, we think the politics of inflation is on the cusp of changing. They're trying to call the bottom of the market. They're saying in the near term, there is going to be the headlines, the recessionary headlines, the job losses, the reports coming in showing massive deflation in certain parts of the economy. They're trying to call the bottom. And they're trying to call that now within the next 3 to 6 months, according to this report, is what they're saying. However, they see in the midterm that inflation won't return to 2%. They're also saying that, as you can see here, the old playbook principle that recession drives below target inflation and looser monetary policy is gone. Again, they're saying they don't think the central banks are going to step in and pump the market. And so you're going to have to live in a world with potentially higher inflation that the central banks want, which means that they're not going to pump all risk assets like we've seen over the last 20 years. Everything went up, right? So what investors have to try and do, if they're trying to beat inflation, if they're medium long-term investors, is invest in specific assets that have a higher trend rate of growth than just the market, right? I believe Bitcoin does, and I believe within the next 3 to 6 months, you will see all of that recessionary headlines coming out. But over 5-10 years, what has higher growth rates apart from crypto? Bitcoin, some other crypto networks are growing extremely fast. And so to have a growth rate that is higher inflation is very good. Now, BlackRock have said they prefer healthcare and other parts of the market that have exposure to, higher growth or at least higher demand. Well, you can say that for other assets as well. I personally think Bitcoin has a very high trend rate of growth that will grow at a higher level than inflation. That's my opinion anyway. And as you can see here, every single economist gets it wrong on inflation every single time. They thought inflation was going to come down all of these occasions and it never did. And now they are telling us that inflation will come down like this, and it probably is going to come down at a much faster rate because they are always wrong. Once inflation starts coming down, China opening back up, you could see it coming off very quickly. However, central banks aren't going to pump the markets very soon. And so over the next few years, you're probably just going to see not very good performance in most risk assets, but that's just the way it is. We have to live with that as of right now. We can sum up what BlackRock think in this report by the asset allocation page that they have right here. So short term, you can see they are essentially trying to time the bottom of the market. They are underweight equities for the short term tactically, as you can see here. Tactically would be 6 to 12 months, right? So they are trying to say that they think the bottom in equities will come in the next 6 to 12 months. Tactically, we're underweight stocks as central banks look to over-tighten policy. We see recessions. So recessions are there, and that's why they're tactically underweight now, is because they think they're going to be getting cheaper prices for many stocks next year. Now we can tie that into Bitcoin and crypto. We know Bitcoin and crypto is more out on the growth curve, and so maybe pricing in those recessions first and farthest, but may also come out first as well. And so you can't just say equities and Bitcoin are alike, because they just aren't. They're going to react at different times, especially to policy. So what you can see here is that strategically they're overweight equities. This is investing 101. Equities generally outperform other types of asset classes if you hold them long enough, over 10 plus years. Longer the better. They outperform by a few percent generally if you're looking at the S&P 500. So what does that mean? If you're a long-term investor with 10 plus years in you, then you can afford to take more risk because the equities do tend to outperform. How does that relate to Bitcoin? If you think Bitcoin is generally a market index with a lot of growth left, and it's got a higher trend rate of growth than most other assets, then you might want to make an allocation, and to some cryptos that you think are going to do well also. So as you can see, tactically, they do see more trouble ahead. but strategically investing in growth has always worked. Now, what you can see here as well is it's actually saying exactly the same thing, but with government bonds, is that they are underweight long dated, but they are also neutral short term. So again, what they're saying is short term, they don't really see short term yields going much higher than this, maybe 25, 50 basis points, maybe, 50 basis points at the maximum. And so they are happy to go into those short dated government bonds because they're paying like 4.25% right now on the 2 year. And so they're happy to go into that because, again, they're trying to time the bottom here. They think that in 6, 12, 18 months, that rates will probably be lower than that. And so they're happy to go into those now. They also see that long dated, they're underweight those because they see inflation staying a little bit higher. And so they think that the long dated end probably has to go up, which means yields down. And so you wouldn't, yields up and price down. So you wouldn't actually buy into those right now. And so they're saying they think within the next 6 to 12 months, the recession will create a market bottom. Things will get easier towards the end of 2023. And if you're a long-term investor, you do allocate a portion of your investments to growth because growth will beat inflation as long as the asset that you're investing in is something like Bitcoin with a higher trend rate of growth and some certainty that it, won't get destroyed or go to zero over time, which of course is a possibility. If you want to know more about putting portfolios and crypto portfolios together, check out the videos in the Crypto Investor course. I'll link that down in the description. Private Discord groups there as well, so you can come and have a chat to me and the other people in there. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.